Charles Harris is an excellent trader and his concept of upside reversals has had a big influence on my trading. I use upside reversals in my own trading in two main ways. Number one, it can indicate that there is supportive action for the stock by large institutions, preferably the stock is a true market leader ticking a lot of the CanSlim criteria. And number two, the upside reversal bar in and of itself may actually act as an entry candlestick if the initial risk relative to the stock's ADR percentage makes sense. Now, none of that may have made sense to you. What are TMLs? What is the ADR percentage? Don't worry, that's what this video is for. Now, I've got plenty of examples to be showing you in this video from present day back to the 1980s, because my belief is these upside reversal bars is a timeless principle. So let me give you an overview of some of the charts we're going to be looking at. Lululemon from 2020, Schlumberger from present day, AMRX from present day, Nvidia from 2005, 2006, Apple from the 1980s, Qualcomm from the 1990s, Nvidia in 2020, Microsoft in the 1990s, and then ZGN. I'm going to take you through a key concept on the 1 hour chart in terms of what I call a shakeout demand tail and when there is low relative volume and it turns out to be a base low. At the end of the video, I'm then going to teach you how to quickly scan for these TML type stocks in the concept of strong uptrends displaying a lot of relative strength and potentially put in these upside reversal bars, what I also call shakeout demand tails and gap down reversal bars. MarketSmith are today's video sponsor. If you're interested in a discounted trial, then there is a link in the comments below. So with all of that being said, let me start here with Lululemon in 2020. Now, it's good to start with Lululemon as there's three main points that I want to indicate on this chart about upside reversal bars. Now, I use candlesticks instead of bars because I just believe there's more information from a supply and demand perspective, and I've just used them for over 10 years, so my eyes and pattern recognition has just dialed into candlestick. But it's the same point on if you're using bars, you're just not going to have the same level of detail, I think. So these upside reversal bars, here's how I think about them. There's two main bars to look for, and I'm just going to point to the first one over here, and we're going to change it from blue and let's just change it to an orange. So there's two types of bars that I'm looking for, and this is the concept here about large operators supporting the stock. The two things large operators in the market require above everything else is liquidity and perceived value, and it's always perceived value because value is in the eye of the beholder, much like beauty, right? So looking at this bar here, now why is this important, and we're going to go on to where is this happening in relation to key moving averages in a second, but let me just teach you about the supply and demand perspective first. So you see this bar here, interesting looking bar, or maybe you're like, it's not a very interesting bar, it's just a green bar. What on earth do you want about? For me, this is a very interesting bar, because what I'm looking for when these stocks are building their continuation basis, I'm looking for evidence that large operators are in there absorbing supply, shaking out the weak hands and accumulating positions, adding to their positions, shaking out the weak hands, all of that good stuff. Because one of my beliefs is TML type stocks, that's true market leader stocks, those that tick the vast majority of CanSlim criteria, are trying to go up, they're trying to go higher with the fewest amount of people on board. So if you have that belief that a TML type stock is trying to go higher with the fewest amount of people on board, then it would make sense that we have to shake out the weak hands. Not you, not me, not you. It's larger operators shaking out the weak hands, get them gone, trigger those stop losses, scare them out, wear them out, get them gone before the stock starts moving higher. So if you have that belief, then when you start looking at a chart and you see it from a psychology perspective, you can start to see things happening, which I think are very interesting when you then see it happening time and time again. So this is the upside reversal concept to indicate there's supportive action for a stock. So when I see a bar like this, I'm really paying attention to it. Why? Because see this, price gaps down. So the prior close is here. The prior close is about $296. The stock gaps down and it opens here on the low of the bar. Interesting, right? Or maybe you don't find it very interesting. I find it very interesting. So see, it gaps down, opens on the low of the bar, and then here it closes on the high of the bar. Now this is Lululemon. It's a highly priced stock, around about $300, and on this day here it's trading about 2.2 million shares on that day. That's not retail traders doing that, that's institutions doing that. Now think about this bar from a supply and demand perspective. Okay, the stock gaps down on the open, so it gaps down there, and then it opens and pushes up immediately. So it gaps down and then on the open, buyers step in immediately. So there is an immediate presence of demand. So this is what I call a gap down reversal bar, similar to an upside reversal bar, just has a different name because for me, with ADHD, being dyslexic as well, I have to take images of things and then reprocess them in my mind and visually try and then understand the concepts in words that make sense for me. So I have to take these teachings of things like Charles Harris would teach you, like Minervini would teach you, all of these great traders, and then for me I have to internalize the concepts but put it in ways and in my own language that then make sense for me. So for me, this is a gap down reversal bar. Price gaps down and then reverses higher. Now, one of the keys with the gap down reversal bar is pay very close attention to where is the open, where is the close, because that can indicate to you how much strength is there. Supply and demand for me is very logical, because if price gaps down and the open is the lower that bar and then the close is the higher that bar, what is that telling me from a demand perspective and a supply perspective? Well, it's telling me there's a lot of demand around and it was easily able to overpower supply. Now, one of the things to do is then look at the volume. So I use the 30 bar average volume. It really doesn't matter if you want to use the 24 day, the 31 day, the 37 day, the 50, it doesn't matter. It's all relative. And for the size of the bases that I trade, the 30 bar average just works perfectly. So do you see this bar here, right? The volume bar on this gap down reversal bar is below the 30 bar average. Interesting. Why is it interesting? Because think of volume as weight. What is this telling us? Well, from a weight perspective, it's just average. And the intention of this bar was to gap down, scare out a load of weak hands underneath the 21-day EMA, which we'll come on to a little bit later, and it just reverses higher. So this is just telling me there isn't much supply that is coming to the market. And I've just realized I put that arrow in the wrong place. Interesting, right? Price then comes back down to this level. Now, this here is a shakeout demand tail. So what is a shakeout demand tail? Do you see here? I'm just going to try and highlight it. So again, I have to internalize concepts for myself. So this here is a shakeout demand tail that actually undercuts the low of the gap down reversal bar. Interesting. Why is it interesting? Because where would a load of stop losses be for people potentially trying to get positioned in this space, and they look at the low of this bar and think, oh, that's got to be support, hasn't it? I'm going to place my stop loss just there, just underneath it. Again, we're trying to look at charts and understand it from a psychology perspective, and what are the bigger boys and girls in the market doing to try and shake out the weak hands. Again, if you have the belief that TML type stocks, or the true market leader stocks, are trying to go higher with the fewest amount of people on board, for me, this is then entirely logical when you start thinking about it. So you see this shakeout demand tail here. Well, what does it do? Price intraday goes down to this level. See this? So price intraday goes down to this level, and I turn this back to blue. So price is going down intraday, undercuts the low of this gap down reversal bar, and then pushes back up. Now, what's quite interesting here, if it undercuts base lows or it undercuts key moving averages with gap down reversal bars or shakeout demand tails, what's the volume doing? Because the volume will tell you how much supply is there. What do you notice about the volume on that bar? It's below the 30 bar average. Now I pointed it to the right volume bar, right? It's below the 30 bar average. What does that tell us about supply? There's not much supply coming to the market. And then over here we can see another shakeout demand tail, shakeout demand tail. Don't worry about the pink arrows yet. Over here, this is a gap down reversal bar. Why is it a gap down reversal bar? Because the prior close is here, it gaps down, opens here, pushes up, and it bounces off the 21-day EMA. Then you have shakeout demand tail coming through. So we'll come on to the pink arrows in a minute. They're trigger bars, which is how I think about entries as well. But what's important in terms of price in relation to the moving averages, now there's nothing magical about these moving averages, but using them as a reference guide for the deliberate practice and trying to just ingrain this in your head, you'll tend to see these shakeout demand tails and gap down reversal bars happen around key moving averages. Now, the two most important ones I think to be paying attention to when you start thinking about it from a larger operator standpoint is the blue line. So the electric blue line is the 21-day EMA. That's going to be a key one to remember. And then the purple line is the 50-day simple moving average. So when you're looking at these charts, pay most attention to the blue line, the 21-day EMA, and the purple line being the 50-day simple moving average, which is also closely aligned with the 10-week simple moving average on the weekly chart. Now, it really doesn't matter if you want to use the 20-day simple moving average instead of the 21-day EMA. They are pretty much of a muchness, but these vicinities around the 21-day EMA or the 50 SMA, it's a vicinity, it's a region, it's an area where I'm looking for supportive action by large operators. So this is Charles Harris's point and how I use it in my own trading of upside reversals, which I then call in my own head gap down reversal bars, shakeout demand tails, because it just makes sense for me. So this is what you'll see: shakeout demand tails, gap down reversal bars, things like that are really good. Now, in terms of, let's go on to trigger bars, then I'll spin it back and start talking about using these upside reversal bars being shakeout demand tails, gap down reversal bars as potential entries as well. What I like to look for in my own trading is these shakeout demand tails or gap down reversal bars, and this final one over here is a really good example. So I'll just delete this pink one to talk about this one here, okay? So what I really like to look for is continuation type bases, and I'm sure many of you are familiar with flags, VCPs, cup and handles, pennants, wedges, all of that good stuff, right? Darvas boxes as well. Here is a flag / VCP. See how the stock starts building higher lows, depends where you were schooled really. You could look at it as a flag, whatever you want to call it. But what I like looking for is shakeout demand tails, gap down reversal bars, playing some games around the 21-day EMA or the 50 SMA. For the vast majority of stocks, the really quick stocks, this will all be happening around the 10-day EMA, which is the black line. But then you get these really tight bars come in. Now I call these trigger bars. Now why do I call them trigger bars? Again, for me, it's the ADHD, it's the dyslexia. I have to take visual concepts and then reprocess it in my mind for ways that work for me and make sense for me. So the trigger bar, and why I call it a trigger bar, is the proverbial final piece of the jigsaw puzzle, because when I'm looking at these bases forming, I'm seeing it as a puzzle. It's a puzzle developing, and I'm trying to piece the pieces of the jigsaw puzzle together. It would help if I could talk, wouldn't it? So I'm trying to piece these pieces of the jigsaw puzzle together. Try and say that 10 times quickly. And then the trigger bar is that final piece of the jigsaw puzzle, because this is where the risk can really make sense. So what I'm then looking for is I'm then usually using buy stop limit orders with a stop loss attached and targeting it through the high of a trigger bar like this. So the ADR of this stock at this moment in time here, and I'll explain that in a minute, is about 2.7%. Now if I just draw this here on quickly, you can see that the initial risk on the trade would be sub 2%. So the ADR percentage, that is the average daily range percentage of the stock over a given period. I use 20 days. It doesn't matter if you want to use 15, 20, 27 and a half, 30, it doesn't really matter. I would be thinking about the base duration that you're trading and then use a applicable number to that. So for me, with initial stop losses, I'm using the ADR as a metric. So I'm trying to get my initial stop loss favorable relative to the average daily range percentage, the ADR percentage of the stock over the last 20 days. Now for me, I like to get the initial risk somewhere between 1/2 and 2/3 versus that ADR percentage. So at this moment in time here, just imagine it was 2.7% and the initial risk on the trade would be around about 2%, which is about 2/3. Obviously there's going to be some slippage and stuff going through here. So around about 2%. A 2% initial stop is pretty tight, and relative to the ADR, that's favorable as well. So sometimes you can get these gap down reversal bars and shakeout demand tails. So if I just go and do one now, if I just clear all this up, right, if we were to look at this, trade here, and we were to put this in blue here and then put this in red here, so you can get these really nice gap down reversal bars. This is a shakeout demand tail. See how it shakes out weak hands, undercuts these recent lows underneath the 21-day EMA as well. Volume is under the 30-bar average. Just tells me there ain't much supply coming to the market. Basically the sellers are gone, if that terminology works well for you as well. But then if you think about the initial risk and say you were targeting it, well, you're going to target it through the high, place a stop loss just underneath the low that bar. The initial risk on the trade is going to be around 4.5%, probably closer to 5% as soon as you factor in some slippage. That's about 2 times the ADR percentage. So that's why I like to look for the supportive action by large operators, shake out the weak hands, and then the trigger bars to come through. But sometimes you can get shakeout demand tails, gap down reversal bars, such as these bars here. If I point to it with the right tool, such as these bars here, where the initial risk may make sense. So if I just take a reading on that one there, through the high, stop loss underneath the low, that's going to be around about 2.7% through this bar, which is pretty similar to the ADR percentage. If you're swing trading off the daily chart and your initial risk is around 2.5–3%, it's still fairly tight in terms of the initial risk. But that's how I think, just as an overview there, before we start going through some more of thinking about gap down reverse bars, shakeout demand tails, upside reverse bars, whatever you want to call them, thinking about the initial risk as well. Does it make sense from a risk perspective? Do you potentially want to build into your position instead of just taking a full position on there? Because then with the knowledge of upside reversal bars is, well, you could potentially start a position here, add here, and then potentially add through the high of a trigger bar and kind of build into the stock as well. Let me show you Schlumberger. So this is present day, right? So the way I think about it and the way I internalize it is I'm looking for evidence that large operators are in there supporting the stocks. At the time of filming this in August of 2023, seeing some relative strength coming through in oil and gas stocks. So Schlumberger, one of the bigger oil and gas stocks, certainly in terms of the field services. So what am I looking at here? I call this bullish synchronicity. There's a synchronicity between what price is doing and the volume. So you can see volume on this bar here is about 2 times the 30-bar average. Schlumberger is a liquid stock. You can see on this day here, it trades 23 million shares and it's around about a $50 stock. Like, that's not Nigel and Dave. That's not retail traders doing that. That is institutions doing it. More bullish synchronicity coming through here. And then as this stock starts basing, and it's kind of still basing, right? What do you see around the 10-day EMA? And then the 21 catches up in here. You have a shakeout demand tail, gap down reversal bar. So do you see how powerful this is? And you'll see this back in the 1980s when we go on to Apple in a couple of minutes. See how the prior closes here and then it gaps down. So on this day here, on August 8th, it gaps down, it opens here, has a little shakeout demand tail that goes down, undercuts the 21-day EMA, also undercuts a lot of these base lows in here, certainly these recent lows over the last couple of weeks, and then pushes up and closes strong here. This is supportive action. This is an upside reversal bar. This is really good to see, certainly when you've seen the strength coming in pre-base as well. So in the rally, before the stock starts even basing, really good action to be seeing in the likes of Schlumberger. Let me show you another one. This is AMRX. So remember what I said about the 21-day EMA and the 50 SMA as well as regions to be looking for gap down reversal bars, shakeout demand tails, upside reversal bars, if that terminology works better for you. So this is AMRX. Now see how the prior closes here. This is a gap down reversal bar. So it gaps down, it opens here, and this will happen on penny stocks and it will happen on much higher quality stocks as well. Gaps down, opens here, shakeout demand tail onto the 50-day moving average just underneath it, and then closes strong here back above the 21-day EMA. Imagine how many weak hands are shaking out on here. Because remember, by the close, this bar does not look like this. Or by the close, this bar does look like this, but what I'm trying to say is intraday, it doesn't look like that. It's a big red scary bar, especially when it's down here on session lows. Now that's why I think in trading it's very important to develop a Bayesian mindset, a Bayesian mentality, which is a fancy way of saying as new information becomes available, you constantly update your decision making process. New information in the market is always becoming available. You cannot be fixed, you cannot be rigid in terms of your view on a stock. You've got to be fluid, as Bruce Lee said, be like water, my friend. So just update your decision making process. What is going on from a supply and demand perspective? What do I think large operators are doing? Now you see this bar here, this is a gap down reversal bar. There's also a bullish engulfing candlestick. So the prior close is here, just here at the low of this candlestick. See the real body there, just in there, then it gaps down, opens here. Now remember what I was telling you with Lululemon, you see this gap down reversal bar, where is the open of that bar? Do you see how the open is the low of the bar and then it pushes up immediately? So price gaps down and then buyers step in immediately as soon as the session opens. Buyers step in. There is an immediate presence of demand, and then tight, and then this is the trigger bar concept, because targeting it through the high of the gap down reverse bar and a stop loss underneath the low would be around about 7%. If you're patient and you wait for the trigger bar to then come through, it's around about 4%, which relative to the ADR percentage of about 7% is much more favorable. Also, what do you notice about the volume on the gap down reversal bar on July 28th? What do you notice about the volume? It's nearly half the 30-bar average. What does that tell you about supply? There ain't much supply. There ain't much sellers there. That's really good to see. So gap down reverse bars, shakeout demand tails, upside reversals on low relative volume in developing continuation bases, which again are Darvas boxes, VCPs, flags, cup and handles, pennants, wedges, all of that good stuff. Okay, low relative volume on these bars undercutting key moving averages and lows and bases can be really good in terms of what is it telling you from a supply and demand perspective. Let's go and do Nvidia. So this is 2005 and 2006. So the blue arrows indicate shakeout demand tails or gap down reverse bars or upside reversals. So you see here, what do you notice around the lows? And remember, it's the institutions, certainly when you're thinking about the Nvidias, the Apples, the Qualcomms, the Microsofts of the world, the Schlumbergers, the Lululemons of the world, and the leading stocks of the day as well that have the liquidity, they meet the CanSlim criteria. It's not me or you creating the lows in the bases. It is institutions when they see enough when they see enough liquidity and perceived value, and they are stepping up and buying. They are absorbing the supply. It is institutions that create the lows in the bases. So something that I like to look for around the lows and bases. So this could be a VCP that has 3 contractions. It could be the bottom. This kind of turns into a bit of a cup and handle type pattern. So if we just imagine, well, this is kind of a cup and handle type pattern. It's not the absolute textbook one. But when you then start looking at the lows in the cup and then in the handle, what I'm looking for is upside reversals, is shakeout demand tails, is gap down reversal bars. Why? Because it is an indication that institutional investors, for whatever reason, are there supporting the stock, accumulating the stock. So here you go at the lows, shakeout demand tail, shakeout demand tail, shakeout demand tail, just underneath the purple line, which is what moving average? The 50-day moving average. And then as this handle starts forming, and the handle will commonly look like a Davis box or a VCP, what do you notice around the lows? Gap down reversal bar, shakeout demand tail, shakeout demand tail. Here's another gap down reversal bar. That is what you will commonly see. We'll come on to relative strength in a couple of minutes. Well, we'll come on to relative strength now as well. So what I'm always looking for is, okay, what are the leading stocks in the market? Now, relative strength is always transitory, right? It is always moving. Day by day, relative strength is moving, both in terms of individual stocks, sectors, and also groups and themes as well. So you can get themes in the market where suddenly oil and gas stocks are very, very strong. Then suddenly it could be EV stocks or electric vehicle stocks are very strong. Then it's semiconductor stocks are very strong. Then it's building residential construction stocks are strong. Then maybe the airline stocks are very strong. So it's all about trying to follow where is the money flowing? Where is the relative strength in the market? Because another belief that I have is the market will never miss the best opportunities, and the best opportunities will show the greatest relative strength. So I put a very heavy emphasis on relative strength. This is a free tool on TradingView. If you search my name in the indicators, this is my relative strength line. You will find it. So I like looking for stocks that are hitting blue dots. What on earth are these blue dots on the relative strength line? They are 52-week highs versus the S&P 500. If you're trading a stock in a different exchange, then I would change it from the S&P 500 to the exchange of the stock that you are trading in. So if I was trading a UK stock, I would trade this to the FTSE 100 or the FTSE to the FTSE 250. Depends if it was kind of a large cap or a mid cap stock. If I was trading an Indian stock, I would trade it to the I would change it to, say, the Nifty or something like that. But as you see the stock starts basing over here, what do you notice within the base, and what is the stock supporting, or what moving average is the stock generally speaking finding supportive action at? Shakeout demand tail on the 21, on the 21, just underneath the 21, on the 21, on the 21. Here you get a really nice trigger bar. So this is what I like to look for, is these upside reversal bars which for me, shakeout demand tails, gap down reverse bars, and then these trigger bars. So trigger bars for me, the final piece of the jigsaw puzzle, is where it gets really, really tight. So it's a very tight range candlestick. Oftentimes it can be an inside bar as well, is sitting on either the 10 EMA or the 21 EMA. Here would be another example of a of a trigger bar coming through in here. So this bar in here, okay, would have been in, 3-year-old it, and then stopped on that bar there, most likely. But these trigger bars that then follow these shakeout demand tails, gap down reverse bars, that's where I'm invariably looking for entries. But I'm also looking at these shakeout demand tails and gap down reverse bars and thinking, okay, does the risk make sense here? So you see, say on, let's do this final one in here, right? If I was targeting through the high and a stop loss underneath the low, well, my initial risk on the trade would be around about 3.5%. If we imagine that the ADR percentage is 3.2, okay, it's just over the ADR percentage. Maybe it's not quite tight enough, but maybe I think I'd like to have my stop loss underneath the 21-day EMA. So it really depends on the market as well. Where is your average gain coming in? If your average gain over your last 5 trades is coming in, or your last 5-10 trades is coming in at like 10%, 15%, if you're swing trading on the daily chart, then you may go, actually around about 3.5% initial risk is really favorable to that. If your average gain, and say it's a really choppy, really difficult market, is only coming in at say 5 or 6%, well, you may want to then hang fire and hold off for a really tight trigger bar where the initial risk is then like maybe around 2% or 2.5%, because then it's much more favorable relative to the average gain that you've been able to achieve over the last 5 or 10 trades. So I think these gap down reverse bars, shakeout demand tails can be an effective entry candlestick in and of their own right. Oftentimes they're a bit more volatile, which will then require wider risk control. So it's just something to be thinking about. This is Apple back in the 1986. So where do you see the stock? It's a leader in its day here. Where do you see the stock is finding supportive action? Look at this blue line. It's not holding to it absolutely to the penny every single time, but you can see it's an area where multiple times you are seeing these games being played. So shakeout demand tails, gap down reverse bars, shakeout demand tail, shakeout demand tail. You'll tend to notice there's a character of the stock as well. So some stocks will show a greater amount of shakeout demand tails, where others you may see more gap down reversal bars. So for Tesla, it's not uncommon around the lows to see a gap down reversal bar. With Apple here, as it's trending up around the lows, it's more common to see a shakeout demand tail. That's just the character of the stock. It is what it is. Try and get to know the character of the stock that you are trading. So this one here, this is then a nice trigger bar that comes through, opens on the low, tight tight little bar in there sitting on the 1021 EMA. That's really nice. This is also a shakeout demand tail, but this is where the risk would have made sense. So through the high with a stop loss underneath the low, if I get the right drawing tool, through the high, stop loss underneath the low would be around about 2.8%. Anything under 3% is pretty tight initial risk. The ADR of this stock, let's imagine here, it's 4.25%. So 2.8%, round that up to 3% for slippage and stuff like that easily. So 3% relative to an ADR of about 4.25%, that's favorable. So sometimes these shakeout demand tails can act as quote-unquote trigger bars in and of their own right. Here's a really nice one. Shakeout demand tail undercuts the 21 EMA, undercuts these recent lows as well. So see how the low of this bar undercuts these lows. Shake them all out. And what do you notice about the volume? There's not much volume. What does that tell you about supply? What does it tell you about the amount of sellers? There's not that many sellers. That's really good to see. So imagine if you were then thinking about this one, not that I was trading in 1986, so what on earth do I know? Look at this here. So the initial risk, about 3.5%. And again, if we imagine that the ADR is about 4%, it's favorable, right? It's around about two-thirds. So I do try and keep the initial risk under the ADR percentage, and I think if it's half to 2/3, I think that there is pretty favorable. But you can start to see, what do these leading stocks, what did they do time and time again? This is 40 odd years ago in 1986. It's moving the same. Qualcomm in the 1990s, it was the leader in the 1990s, and I give much greater weight and try and understand much more. How do the leading stocks act? I don't care about kind of a piece of just terrible stock basically that's like a dollar biotech stock or something like this. Now Qualcomm is split adjusted 101 times here, but I want to know, like, I'm not really interested in kind of like a rubbish biotech stock with no earnings, no sales, has a market cap of 50 million and trades a couple hundred shares on a 30-day average volume and is a phase 4 decline. I don't care about those stocks. I care about what do the leaders do, what do the leading stocks do of the day on a repeatable basis that is timeless. You can see this from 40 years ago, 100 years ago, present day. Okay, the names may have changed, as the famous book says, but it's the stocks that have changed. But in terms of like the stocks change, the name changed, but in terms of supply and demand, how do these stocks move, it's absolutely timeless. So if you go and look at Qualcomm here, shakeout demand tail, gap down reversal bar. Doesn't this bar here look very similar to what Lululemon did? See Lululemon here, gap down reverse bar, opens on the low, pushes up. Isn't that interesting? This bar here, gap down, open on the low, push up. Isn't that interesting? Look at the demand coming through with the volume and the positive price action, bullish synchronicity around the lows of the bases. So you get one low here, two lows here, three lows here. What do you notice about each of the lows? Shakeout demand tail, shakeout demand tail, shakeout demand tail. Now this is where these are the setups that I absolutely love. Like this setup here, for me, is I wasn't trading in 1993. But this setup, if I was trading in 1993, all bloody over it. Like, this is ridiculously good. This setup here, ridiculously good. Why? Look at the 52-week highs on the relative strength line. Look at the 52-week highs on the relative strength line. And you've had these shakeout demand tails coming through, and then you get this tight little trigger bar, and what do you notice about the volume? So extremely tight range bar following these shakeout demand tails on low relative volume tells you what about supply? Tells you what about how many sellers are around? There ain't money around. This is ideal. And then it's about thinking about, okay, does the risk make sense relative to the ADR percentage? When you look at the lows here, you have one low, two low, three low, four low, five low, and then you get the tight little pivot. What do you notice about the lows, which are holding around the 50-day moving average? Shakeout demand tail, shakeout demand tail, shakeout demand tail, shakeout demand tail, gap down reversal bar. What do you notice about the volume on the gap down reversal bar? There's hardly any volume. What do you notice about the volume in the pivot? There's hardly any volume, and the tightness and price. What does that tell you about supply? There's very little supply coming to the market. So that, like that there, these two setups for me, certainly this one here, this is absolutely textbook. And then it's trying to get positioned, free roll, and then try and sit for the intermediate term trend. I'm an intermediate term trend follower, so I'm trying to get position, take all the risk out, sit for the intermediate term trend. I've done loads of videos on that recently, so I won't dive deep into that right now. This is Nvidia back in 2020. So what do you see at the lows in 2020 for Nvidia? What do you see? Obviously, we know, again, Bayesian mentality. Go back, study these stocks. Like, how did they move? What did they do? What are the repeatable characteristics you keep seeing time and time and time again? Is there anything that's happening in terms of price relative to moving averages that you keep seeing time and time and time again, such as gap down reversal bars, shakeout demand tails, upside reversal bars around the 21-day EMA or the 50 SMA, or potentially the 200-day moving average? So even though Nvidia down here is actually back on its 200-day moving average, look at the relative strength that the stock is exhibiting pivoting. Interesting, right? Then it turns into we've got to be a little bit creative, but somewhat of a cup and handle type pattern. And then before this stock really starts breaking out, what do you notice about this gap down reversal bar? Where does the price open? It opens right on the 21-day EMA. The open is the low of the day, and then it pushes up and goes. Shakeout demand tail onto the 21. Shakeout demand tail undercutting the 21. Gap down reversal bar undercutting the 21. Then you get a really nice trigger bar coming through in there as well. So then when you see these gap down reversal bars and shakeout demand tails, I'm looking at them thinking, okay, nice. I would like to have an initial stop loss down here and be targeting it somewhat lower within the base as well. But does the risk make sense? So there to there, it's still pretty tight, like 3.8% or so. Again, I would have to then look at, well, what is the ADR of the stock there? What's my average gain over the last 5, 10, 15 trades, something like that? Does the initial risk make sense with this upside reversal bar, with this shakeout demand tail? But look at the strength Nvidia was displaying. But this is how these leading stocks move. This is Microsoft, obviously a leader, still kind of to present day as well, but this is Microsoft in 1991. Look at this shakeout demand tail. So this is what I really like to see. This is when you get the shakeout demand tail. So this is a developing continuation base. This is much more of a Davis box forming in here. Then see how you get the shakeout demand tail, and then see how the shakeout demand tail undercuts many of the recent lows, undercuts the 1021 EMA. Then where is the close of that bar as well? This is a subtlety, but where is the close of said upside reversal bar? See how it closes on the high of the day. That's another subtle indication of strength. What do you notice about the volume? There's not much volume. What does that tell you about supply? There ain't much supply. And then you get this trigger bar. So this is the concept here, right? If I was targeting it through the high, now I wasn't trading in 1991, so what on earth do I know? But if you look at this bar here, so targeting it through the high, stop loss underneath the low, that would be around about 2.8% initial risk. Now, if we imagine that the ADR percentage, that's up here, it's 3%, so maybe it's closer to like 2.5% at this moment in time. Over here, I think it would have been less because these are fairly widespread candlesticks that would have added to the ADR. But over here, imagine, well, just for the purpose of this, imagine that the ADR percentage here is 3%. So the initial stop loss is about the same as the ADR percentage, which we're going to say is 3%. However, what happens on the very next bar here is you get a trigger bar. So now suddenly the initial risk is not close to 3%, it's now 1%. Make sense? So now it is a third versus the imaginary ADR percentage, which we're imagining is 3% at this moment in time here. So for me, I'd rather wait for trigger bars often and potentially try it once or twice with the tighter initial risk control. But these upside reverse bars, shakeout demand tails, gap down reverse bars, and then trigger bars that follow subsequently within the next couple of candlesticks, I really like to see that in my trading. Here's a shakeout demand tail. Now, it's a red bar, isn't it really scary? Yeah, maybe, but you're taking out a lot of stop losses here. And then what happens on the very next bar? Trigger bar. What do you notice about the volume? There's hardly any volume. What does that tell you about supply? There ain't much supply. Is it starting to make sense here a little bit? Now, let me go and show you this one before I show you how I go about screening for these stocks. So this one here, relatively recent. This is July of 2023. So again, it's the bullish synchronicity point. Look at the buying, look at the buying, look at the buying. Large operators, most active, first hour, last hour of the session. Now this actually turns out to be a cup and handle type pattern with a lower handle around about a mid handle. But the key I want to emphasize here is, I'll just enlarge this like this. You see this shakeout demand tail, and I was blabbering on earlier about that Bayesian mentality, that Bayesian way of thinking. You get a shakeout demand tail in the middle of the base, and what do you notice about the volume? There's not much volume. It's not even above the 30-bar average. What does that tell you about sellers? What does that tell you about supply? There's hardly any. So again, it's about trying to be a detective, trying to piece those pieces of the jigsaw puzzle together. That's what I'm trying to do in my own trading. Okay, whatever large operator, whatever Livermore called it, the irresistible force, whatever irresistible force is moving this stock, what are they doing? I don't necessarily need to know the why are they doing it, but I want to know they are doing it. Very big difference. I don't need to know the why, but I want to know that they are. So here I can visually see the buying. I'm very visual how I learn. I can visually see the buying. I can see widespread candlesticks, increased high relative volume, widespread candlestick, high relative volume. I can see it, and then as this base starts developing, I can see shakeout demand tail, low relative volume, and then this turns out to be here the low of a cup and handle type pattern. Well, that just tells me there's not much supply, and then multiple tight candlesticks, low relative volume, indicate to me there's very little supply that is coming to the market. So with all of that being said, you're probably now wondering, how on earth do you scan for them quickly? So let me show you a scan that you can build. This is on my own custom built stock scanner, which we call Stock Screen Hero. So here's Schlumberger that I was showing you earlier that's popping up. Now I've got this specifically set to oil and gas related stocks. I was showing you Schlumberger. a little bit earlier on, you can visually see here, you can see the buy coming through. This is then the 21-day SMA. We just have the SMA instead of the EMAs available on these charts here in the scanner, but you can visually see the shakeout demand tails, the gap down reverse bars coming through. You can see the sales accelerating for Schlumberger. 8 quarters ago, 5.85 billion, now going up to 8.1 billion. That is very good growth. The EPS, quarterly EPS accelerating as well. We like to see that. So how can you quickly find stocks like this? Now, these are just oil and gas stocks because there's some strength currently in oil and gas. There's another interesting one down here, which I'll show you, which is NE. So how do you quickly find these stocks here that are building bases like this? Again, on NE, you can see, visually see in this base here, you can see the shakeout demand tails, the gap down reverse bars coming through. Look at the acceleration in sales. That would be 250 million up to 640 million now coming through. That's obviously in billions, so it'd be 0.64 billion, which is 640 million dollars. How can you quickly identify these? Well, let me take you back to the table. So we'll reverse engineer it. And let me show you the scan that I have got set up to find these. So looking for oil and gas, highest relative strength, we now have 5 exchanges. We've got US, UK, India, and Canada coming on. So I've selected the sector includes energy. I want the price to be greater than $1. I want price above the 50 SMA. I want price above the 200 SMA to indicate the stock is in a long-term uptrend. I want the 50-day average volume greater than 100K to make sure there is at least a little bit of liquidity there. And I want the sales year over year to be above 18%. Now, the reason I chose 18% because Schlumberger's year-over-year sales were 19%, so I just wanted to get Schlumberger to show you one of those. But you can play around with it. You can add earnings in here. You could do this for other sectors. You could do it more broad brush. You can go and create whichever ones you want to create. We have lots and lots of different things that you can be doing here. But something else that I want to show you as well is in the table, we have the relative strength rankings. So we have relative strength. So say you saw strength in a specific sector. So at the minute, it may be energy, being oil and gas stocks. So we have relative strength sector rankings on a 1-week basis, a 3-month basis, and also a 12-month basis. We also have them against all the stocks for various exchanges in our database as well on a 1-week, 3-month, and 12-month. But say if you were interested in a specific sector, so maybe that is solar stocks, or maybe it's oil and gas stocks, or maybe it is it's tech-related stocks or financial stocks and more of the banking stocks, then what you could do is you could select the relative strength sector ranking, say on 3-month, and then you could go and look at those ones first and create your own watch list and do all of that. But this is how I use my screener for specific areas of the market to try and dial in and find those stronger stocks that are basing constructively and I want to do more work on as a very quick initial screener. So that's it, guys. I wrap it up there. Thank you very much for watching this video. I really do appreciate the support on the channel. If you made it all this way, please do like the video, subscribe to the channel if you're new. If you have any questions, please leave me a comment down below. I'll do my best to get back to you, and thank you very much for watching. See you in the next one.